What's good, y'all? It's your boy TBT, aka the Brainless Trader, and we are back with another one. Today, we're talking about combining two of ICT's most strong concepts to combine for a very accurate setup. So, stay with me. We're about to get into it. Let's go.
But I frame my trades off of the setups that are formed in the daily, the weekly, the daily, the 4-hour, 2-hour. So let's start there. If you're looking, you already know that there's a breaker here. High, low, higher high, lowest two down closed candles, breaker, fair value gap across from it. This is the breaker zone here, and you see price trades up into that. If this was the high of the breaker zone here, and price trades up into that and then up into the fair value gap at the same time. So boom, already on Monday and Tuesday, we're like, oh, interesting. And if you zoom in here, we'll get here on the lower time frames as well. But if you zoom in here, you can tell that on Tuesday, price first takes out the buy side liquidity from the previous Friday, and the Monday goes into the fair value gap that was created on the previous Thursday, and also into the breaker, correct? Okay, so this is just a higher time frame outlook. You already know this based off of Monday and Tuesday, but on Tuesday, really that's where you want to be paying attention to, because that run on liquidity happens. That's when you can potentially start getting into trades. So let's go down to that time frame. Let's go down to probably the hour. So boom, this is the Tuesday, right? Now, these red bands that you see on the chart are how I determine where my Asian range is. And the reason why I want to know where my Asian range is because my Asian range will tell me each day, one, where stops are that we can run past to then activate into new trades. But in general, a lot of times the chart will use the Asian range to then prepare itself for more trades, right? And specifically the 12 a.m. open within that Asian range. ICT calls it the New York 12 a.m. open, New York session 12 a.m. open is what he calls it. But essentially it's just 12 a.m. each day. That anchoring point a lot of times is where ICT will use to then say, if I'm bearish at that 12 a.m. open, let's just say right here, where's that 12 a.m. open? Right here. Here's my line for 12 a.m. open. Once price goes above that 12 a.m. open into a PD array around liquidity, fair value gap, now I'm looking for trades continuing in the direction that I want, right? In the sell side. Okay, so now let's break down the actual things on the chart that you could use, right? If we go down to the 30-minute, and let me make sure my executions are on the chart too. Now, looking at this, you see what I just outlined? There was buy side liquidity into a fair value gap. Boom, you ran those stops at 5 a.m. and then you begin to make moves to the bottom side. So the Asian range, we're looking at 1900, which 1900 is what? 7 o'clock? 7 o'clock New York time, all the way to 4 a.m. New York time. So there's your Asian range, 7 o'clock New York time to 4 a.m. New York time. Now, 1900, yeah, that's correct. Now, ICT's focus point within the Asian range, he likes to look at that first half, so that's 7 a.m. to 12 a.m. That price action, he uses that 12 a.m. anchoring point in this strategy, right? I call it the Asian range sniper because it's very accurate, where you have a run on liquidity against the higher time frame bias into a PD array. And this is actually what he talked about. If you look at his most recent video on order flow, he gives 2 or 3 examples where price runs liquidity and then creates breakers, and then those breakers, he uses those breakers to enter into trades. Where I actually entered, I'll break down what I actually did. Okay, here we go. So now, knowing that we're already bearish for the week, right? Knowing where you're at, right, in the market, you've got that same setup. First, look for your Asian range, 12 a.m. open. Okay, now you got your 12 a.m. open. Now you're looking for a run on liquidity against the higher time frame bias, which is overly bearish. Okay, you're looking for a run on liquidity into what? A PD array. So let's say a fair value gap. It could be an order block. It could be a fair value gap and an order block. It could be a breaker. It could be anything. Okay, you just want to see how price is going to respond to that PD array. All right, so let's look and see how price responds to this one. On the hourly chart, we have an hourly fair value gap. Not only do we have that, but I don't have tabulated on my chart this hourly order block. All right, stop close candle. Boom. So you have a combination of an order block, a fair value gap, and a run on liquidity. You have these stops here that you ran out earlier in the morning, and then you run out these relatively equal highs into the fair value gap. Now you want to know where is price going to finish within this fair value gap. You know, ICT likes to talk about the consequential encroachment, correct? So we're looking at the midpoint of this fair value gap. You want to see where exactly on the midpoint is price going to finish. Is it going to finish right in the middle, just above the midpoint? And wherever it finishes, regardless, you really just want it to finish within the fair value gap and then give you some impulsive movement away from the fair value gap, regardless of where it finishes in the fair value gap, so long as it doesn't finish above the fair value gap. When I say finish, I mean close, so long as the candle doesn't close above the fair value gap, right? And keeping this all in the mind frame of the fact that we want to know where that target was, right? So if we go back to our weekly target, we want to make sure that we understand where is our weekly target, because that's how we're going to know when to stop for the week, right? This target, and this target. We're going to leave that, but this is what I labeled as that weekly target. All right. So within this, understanding that this is the weekly potential target, right, as well as sell side liquidity, this would be our stopping point for the week. If we got this would be our stopping point, and you already know that you've got this, right? So earlier in the video I said this was, but I didn't realize that we were a week ahead. So this was my weekly target, my hope, right? And then I've also got the fair value gap. Let's go into that. I outlined it as something that if price gets to it, this is where you would potentially take your profits or look to be safe and stop, just because you don't know what price is going to do next, right? Boom. So you got the potential weekly target, you got the potential fair value gap on the hourly that you're looking for a price to potentially reach. Now, if it reaches it, you have to be disciplined and take your profits, because if it reaches it, that means that it's your stopping point. If price goes above or below your target, it's possible, but you should still have in your mind that this is what I need, this is what I want. I'm not going to be greedy. I'm not going to be upset if it reaches my target and surpasses my target and gets 200 more pips, and I could have been in for 200 more pips. No, you're just trying to get into what you need for the week, your low hanging fruit target. And I think a lot of times that low hanging fruit, us not being able to determine that and come to terms with the fact that that's all we need for the week, that hurts a lot of traders. So that's what you need to understand first and foremost, is your targets, they have to be modest and within reason, so that you know when to stop for the week. Okay, so now let's frame the trade again. We had a run on higher time frame liquidity into a fair value gap, into an order block. Okay, cool. Now, what do we need to form? Now, we also know that we're above the 12 a.m. open. If we're bearish, we want to take trades above the 12 a.m. open or right around the 12 a.m. open. So you see where my entries are at, right at the 12 a.m. or above the 12 a.m. open within that fair value gap, and then also right at the 12 a.m. open within the overall framework, right? So if we go down to the lower time frames, we can kind of see how you can be nimble within your entries. Okay, we have a high, low, higher high, ICT breaker, lowest down close candle, reach across from it. What do you have? Fair value gap. Cool. If we go into the lower time frames of 5 minute, that fair value gap will be a little more clear. And like I said earlier, I use the 15, the 5, and the 3 minute to determine where I'm going to get in on my trades. I like to use all three at the same time because it helps me to understand the distance within which fair value gaps that I'm using, and understand where my most safe entry will be, right? Because now from the 15 minute to the 5, you see we have a difference in the fair value gap. This fair value gap is much larger, and then we still have that same area. Matter of fact, we have a lower area, high, low, higher, high, right, for a breaker. We also have this area, high, low, higher, high for a breaker, right? You see that price traded up into the fair value gap across from this breaker, lowest down close candle, fair value gap, that's a breaker, valid. traded into it. I didn't get into that trade, right? That's at 3 a.m. in the morning. It's within the ICT London kill zone, which is 2 a.m. to 5 a.m. So it could have been a clean entry. As you see, I didn't get in there. I did get in here, right? I got in high, high, low, higher, high. This is a breaker. Lowest two down close candles. You look across from it. If there's a fair value gap there, it's valid. Price traded up into it once. I said, oh darn, I already missed that entry. But cool, price traded up into this fair value gap here. There's an order block here. I'm like, okay, this could be a good entry for me. Then what happened? Price moves right against me. I had my stop set above this fair value gap. Price ran me out. So boom, there's a lesson that everything's not going to be perfect, right? You understand that everything's not going to be perfect, but you continue to roll with the punches. Knowing that your ultimate targets are still below, you're still bearish, and here's the first area for a target that you could use, right? Within that overall time frame, we know that we highlighted before where our ultimate target would be, right? But here's some relatively equal lows that we could target, and you'll see that when I re-entered the trade, I re-entered once price touched this fair value gap for the second time. Now ICT talks about with the PD array, if it's entering into a PD array once, twice, okay, it's cool, it's still valid. 3 times, that's a no-go. Probably not going to take that trade, right? So you see this is just the second time that price entered into this 5-minute fair value gap. Boom, fair value gap. We can outline it for you if you'd like. Mind you, keep in mind what we talked about with the 12 a.m. open. This entry is above the 12 a.m. open, right? So probably one of the safer entries. So boom, I took that trade. Price didn't even go above. I had my stop set above this fair value gap here, but price didn't even go above my entry. And then I went to work, and once I got to my office and sat down, I was like, okay, let's look at the trade. Now, typically I like to actually watch my trades because I would have taken my profits right here, to be honest with you, if I was watching. But obviously things happen. You got to be ready for work. You got to get ready for work. Okay, so I actually got to work, and this is the risk that you run doing trading while working and doing all that, because price could have easily ran my entry point, right, and I'd have just been out of the trade. But it was graceful. So I got to work and realized what was going on. I was like, cool, let me take my money right now. I'm chilling.